Hello, I'm Kimberley Dondo, Digital Content Manager, and welcome to In Conversation With, the podcast series that delves into the world of financial services and brings you face to face with some of the most notable figures in the industry. Listen as we discuss topics that are currently facing the industry and hear from visionary CEOs to disruptive innovators as we bring you a diverse array of voices and perspectives. We'll explore the challenges they faced, the lessons they've learned, and the insights they have to share about the ever-evolving landscape of financial services. Hello and welcome to In Conversation With. I'm Kimberley Dondo, and in today's episode, I'm joined by Jordan Sriharan, Fund Manager at Canada Life Asset Management. Thank you for joining me today, Jordan.
Afternoon, Kimberley. Thank you for having me.
So you've done this a couple of times, but for those who may not have listened to those episodes, which I would say go back and listen, but could you give us a bit of a background into yourself?
Sure. So my name is Jordan Sriharan. I'm a fund manager at Canada Life Asset Management. I've been here for just over 3 years now. And prior to being here, I was the head of the model portfolio services at Canaccord Genuity. And prior to that was on the investment consulting side with Mercer.
Okay, fantastic. So could you give a brief recap from earlier this year and highlight any adjustments that have been made in light of recent developments? Are there any specific events or trends that have influenced your current perspective?
Yeah, and I presume we want to talk about in with respect to the last few months as opposed to kind of over the course of the year. Yeah, no, because it's very easy to anchor yourself in what happened in the last week and then create a narrative around that. But this call comes at a timely point. We are a week after the Fed cut rates by 50 basis points, which came as a surprise to us. But that is very much, I don't want to call it a line in the sand, but it really is a precursor to what we think will be the backdrop for quite a strong economy, global as well as in the US, for the next certainly 3 months and more likely to be 6 months. And why do I say that? Well, the Fed have decided to cut rates when growth in the US is still remarkably strong. Now, at the margin, they mentioned that unemployment was getting weaker. And they spoke about inflation improving. But when the Fed have cut interest rates at a time of strong economic growth, that has normally been the opportunity for the economy to go on and kind of and kick on from there. And that's what I think we're most bullish about at this point. And on a one quarter view, and I said this on the desk last week, I don't think I've ever been more bullish, more high conviction bullish on a one quarter view than I am today, because the backdrop is just of, there's more liquidity out there from the rate cuts. There is more optimism through job security, globally as well as in the US, and that together is going to lead to sort of consumer demand being maintained, if not pushing on, and that to us is a sign of a bullish backdrop. And actually, just this week alone, we have seen China, and I'll use a very generic term, have launched something of a bazooka in terms of fiscal policy as well as monetary policy. They've been cutting the reserve requirement ratio there. They have gone away and said we're going to fund banks in order to improve the real estate market there. And that has been fantastic for particularly emerging markets in the last 3 or 4 days. We're recording this on a Thursday, and this all started on a Monday. We can see that has transferred through to French luxury stocks, German industrial stocks. The mining companies have all performed spectacularly well over the last 4 days because of this, what we think might be the start of something a bit more pronounced from China. So you have the Fed cutting interest rates by 50 basis points. You have China, who I suspect, in light of the Fed's actions, have come out and decided to turn much more positive on fiscal policy and monetary policy, which is something they kind of had half committed to previously. And you might remember that they've had a couple of false starts where they've suggested they do something and then perhaps reneged on that. They really seem to have gone in feet first with this new set of measures. And so those two combined together are important. And I think the third question that leaves me still bullish is we are 20 days away from the US election, 20 days or so, 25 days. And, regardless of whether it's a Democrat or a Republican win, both leaders of those parties have, been fairly relentless in their messaging that they want to borrow more, government borrowing to increase, to spend more on the economy.
Mm-hmm.
And whilst that might have repercussions down the line, and that those repercussions might be, a month into it, it might be more likely to be, 6 months, 12 months away. I think that backdrop is also going to be positive for economic sentiment. And so, as I mentioned, on a one-quarter view, the final quarter of 2024, I am uncharacteristically bullish on the outlook. And when we spoke in January of this year, when we spoke in the middle of last year, you might remember that I was perhaps in the camp of a hard landing. Interest rates have gone up. We're all gonna be on porridge and gruel for the next 2 years of our lives. And I'm not saying that's not going to happen. But, and I will refer to the previous podcast that you kindly referenced earlier, I did say in January, I think we've come back to I think the one thing we learned from last year was, what if we're wrong?
Yeah.
And we came into the start of this year, perhaps, glass half empty, but ensuring that our portfolio was constructed appropriately. So if we were wrong and growth was robust and consumer spending, remained intact, and US equity markets continued to go from good to better, that we would be positioned to capture that, and we've done that. And so I'm bullish now, having been bearish for some time, but we haven't. I don't think that's changed our investment strategy, should I say, or our investment approach, which is, have some humility and think about what if you're wrong. It's not about, going red or black. In the same way that me sounding bullish to you now is not that we've, put on, lots more risk in the portfolio. We have moved that way, incrementally, and we've done that, in fact, in the days since the Fed cut rates. I'm bullish and think things will go well, and we're positioned accordingly. But we haven't gone, we haven't decided to go red or black in terms of betting on the roulette table. It's more moving more chips into more numbers on the roulette table. I mean, this is a terrible analogy. I'm sorry, but if you can understand that it's about the incremental bets that you're making in the right direction, rather than trying to decide it on a coin toss.
Yeah. No, not going all in, but not being as reserved, I assume.
Yes. Yeah. And I think that is the nature of multi-asset portfolio management, which is you can get the macro forecast absolutely spot on, but the chances are that you will not get your positioning correct, or you'll be in the right areas of the market, but you won't have enough of your chips on the table. And I think we've learned a bit to think about how we position the portfolio to benefit from growth in areas that we're positive. A good example of where we had success this year is the Nasdaq. It had a strong 23. We invested perhaps later into last year than we should have done, but it's had another strong year despite the bears pulling it down periodically. Nvidia is the poster child of being beaten up and built back up again. But it's something that we're proud to say we've had good success in the Nasdaq, and even in our direct positions in our income strategy. We've had Broadcom and TSMC, Taiwanese Semiconductor, which are chip making companies, and they have been actually the most significant beneficiary in the AI story so far, alongside the golden child of Nvidia. So I guess my point is that we've made strong returns in the right areas. So despite having a slightly bearish macro disposition, by getting lots of small things right, we've been able to sort of do relatively well year to date.
Yeah, and looking at the UK's current market environment, how significant are global economic trends and market volatility compared to other factors impacting the UK market right now?
Yeah, I think, despite recent efforts from lots of developed market governments to kind of deglobalize, or at least, the march of the far right to create differences between people. There is, the fact is we still live in a globalized world, and the UK does not exist in isolation. And the question of how isolated are they from global economic trends is, the answer is that hasn't really changed, as I said, despite polarized politics over the last couple of years. I mean, even if you look at the FTSE 100, which I think is widely understood to be a very global index of names, albeit the UK index, 30% of the revenue from FTSE 100 companies are generated in the US. And so, it is intrinsically linked to the US and thereby kind of global economic growth. And I think the second thing I'd add to that as well, I know we talk about equities a lot here, and it is obviously the risk asset. It is where you can kind of win and lose performance. But there is a high correlation amongst developed market equities. There's no doubt about that. When the US does well, it often transfers through to the UK, to Europe, to Japan, and so to summarize my point, I think global economic trends still remain really important to the UK, and actually, perhaps in a world where we have less influence in Europe, that's perhaps even more so now than it was nearly 8 years ago since Brexit happened.
Yeah, and in this uncertain environment, we have a budget coming up that everyone is anticipating. Are there any specific strategies or asset allocations that can mitigate risk?
Putting the budget to one side for a minute, because not only is that a hot potato, I don't think anybody knows what's going to happen. And in fact, actually, I do give the current government some credit for not leaking everything, in advance of that, because I found that to be quite a poor way of governing. But let me just talk about, I mean, the question of uncertainty. I would say from a macro perspective, it feels far less uncertain than it did a year ago, and certainly 2 years ago when the rate rising. We were in a period of monetary policy tightening and rates were rising. And so in an environment, a macro environment where we're actually a bit more comfortable and a bit more high conviction, for us, the real winner will be equities. And I do mean that over perhaps a shorter time frame than I would normally talk to. But we certainly think that is where clients want to be positioned. But not just equities, also credit markets, corporate bonds have done particularly well, and not just investment grade, which is up almost 5% year to date, but high yield, which I think high yield is a great example of a sub-asset class within fixed income that many is not fair of me, that was widely considered to be an asset class that would blow up in the face of higher rates and kind of weaker consumer demand. The reality is the high yield market is different to where it was 10 years ago, and the same rules don't apply in the same ways, albeit I do acknowledge that it has a high beta to risk. So when you have poor days in the market, high yield does sell off. But it's been a strong performer year to date. It had a great 2023 as well. And I think for us, and if we were to talk to advisors and talk to investors, we would, equities and credit, corporate bonds would, for us, still remain the big winner for the rest of this year. And I think, I'm pretty sure when we spoke back in January, I was extolling the virtues of government bonds. And indeed, I'm not sure I have met anybody who wasn't talking about bonds as the big play in 2024. I've seen so many articles talking to that, and I have some sympathy for it, and I agree with it. But, bonds have been okay. Government bonds, I'm referencing at this point, but they're still negative year to date, minus 2% for the World Global Bond Index. And I think that reflects one, that we're not perhaps, we've only just started the rate cutting cycle, but two, the the returns have been in riskier assets. That's, because we still live in a global economy which is growing, relatively strongly now. And whether that changes over the next 6 months, I don't know. But we remain quite confident in the short term. And this is of course famous last words, but that we'll have a good run into year end. Maybe we don't get the Santa rally that everyone expects at Christmas, but that's probably because it's going to come early this year. And so, yeah, I wouldn't call it an uncertain environment in the short term.
Okay.
At least economically.
Yeah. And are there any opportunities or any other opportunities that might emerge for UK investors in this landscape?
Let me think. I mean, in terms of what opportunities there might be, and when we talk about this, Kimberley, we're talking about in terms of assets. They might. I mean, so outside of riskier assets like equities and corporate bonds or credit that I mentioned earlier. I guess one of the things that we have been exposed to over the last 6 months and still have a high conviction in, and if I can talk domestically from a UK perspective, is that we have been a big buyer of the home builders in our income portfolios. They suffered in 22 as you might have expected to, with higher rates and sort of growth in the UK that was slowing down materially. The difference today is that we have a much more stable economic and political environment, and we have a government that wants to build more houses and is quite committed to that, despite there being difficulties in doing that. But I think we're pretty confident in the entire value chain for the home builders. So not just those building the houses, but those manufacturing the bricks and to some extent those involved in kind of real estate sales and so on. To us, that is one area that we think has got a lot of momentum behind it. And as rates come down, as mortgage rates come down as a function of that, we think it draws more people into the housing market. I mean, we've already seen house prices tick up now, and that's been the best part of the year. And so if there was a domestic story for the UK investor, the home builders, and perhaps I won't name the names that we have, but they certainly have been doing very well. There's actually some M&A amongst them now because of the opportunity they think is there to buy up some of the smaller developers and take them over. So that would be one place that we've seen success in the portfolios, and the thing has still got legs to run, so to speak.
Yeah. I also work on our mortgage brand, our sister brand, Mortgage Strategi, and I have seen, probably for the first time in a long time, a lot more positive outlooks when it comes to the mortgage industry in general. And that is to do with the house building, because I think that was the one thing that a lot of mortgage professionals were pushing for. So I definitely have seen that on my end as well. Moving on towards the end of this year, what other factors should we all be aware of and paying close attention to as we plan for the last quarter, especially in light of any recent market fluctuations?
Yeah, so I mean, what should we look out for? I guess, and maybe this comes under, what advice would you give going into year end? And I think I'd say to investors, I'd say to advisors is, broadly speaking, try and remain fully invested. I think now is not the time to try and be cute about coming out of risk markets, equity markets, when they're at their highs. In fact, when equity markets are at their highs, that's normally a positive thing. It normally leads on to, higher highs, later on down the line. So I would say being fully invested at this point in the cycle, which, as I said, and I'll caveat, maybe towards the end, but there is still, in our opinion, a bit more juice left in there. I try and remain fully invested, and we're doing that in our own portfolios, and as new money comes in, I'd say a year ago we were thinking about being deliberate in putting that to work in the markets, because bond markets are volatile, equity markets are volatile. Today, we are, as you know, if when new money comes in, we're investing it almost instantaneous, because that is our level of conviction in corporate bond markets, in equity markets. And so if our action should be any guide, it is we want to be really invested at this point in the cycle, at this point as we get come into year end.
Mm-hmm. And what are your top recommendations for any financial advisors to stay informed and adapt their strategies as the economic landscape evolves, both domestically and globally?
Yeah, I think in today's world there is so much more access than there was even 5 years ago, and I think maybe COVID led to more individuals spinning off to do their own independent thing, which is great. There's lots of, I think, really interesting people on Twitter. There's a lot of FinTwits, I think they're self-described as, who and some are biased because they have got they have their own biases because they are aligned to US equity markets, or they're big supporters of emerging markets, but there are lots of interesting names in that space. When I think about journalists, and particularly free journalists that you can access, there's a chap called John Authors, who is a Bloomberg columnist, former Financial Times columnist, who does a free morning daily newsletter, which is fascinating. It's a really good insight into what's going on in markets. I think he picks apart quite neatly the salient points in real time of what's going on in different jurisdictions. Bloomberg actually, not to pump this as a Bloomberg advert, but they do a very interesting midday UK money newsletter as well, email, which is very good domestically. And I think for advisors who are, it does cover the whole range of issues that happens in UK finance, whether it be FCA rules about XYZ, or whether it be about current account rates now that the Bank of England have cut interest rates. I think they're very good at taking the mood of kind of UK PLC, which I think is really useful to advisors as well. Perhaps slightly outside of the economic sphere, I think the News Agents is an exceptional podcast. They are, I think, quite partisan, and I quite enjoy that. They're very good at dissecting the issues. And I guess naturally that is more political than economics base, but I find it very useful to just understand what's going on in domestic politics. There's also a podcast called This Is Money. It's Robert Peston, and the Channel 4 lady, and I've forgotten her name, which is not professional of me to not be able to recall that. She's a lovely lady, famously from Sunderland, and she mentions it 3 times on her podcast every week. But they do a very good This Is Money podcast talking about, again, domestic economic policies in the UK that are very relevant to advisors and their client base. And I'd recommend that as a podcast as well.
Yeah. So many resources out there for sure. But as we wrap up now, Jordan, I just wanted to know if you had any final words of wisdom or key takeaways you'd like to leave with our audience navigating the last part of this year.
Yeah, what would I leave people with? So, I mean, I have mentioned the point about remaining fully invested, and that doesn't change. What I would probably say is, perhaps don't be so wedded to the macro forecast. Now, I have mentioned a lot of macro reasons for being bullish, and this is not to correct myself, but it's more that what's more important is ensuring that where you place your chips, where you choose to invest, is is more important than just the idea of investing itself. So at the moment, we think emerging markets are going to be a place, that an area of the equity market that outperforms, and that is driven by a weaker US dollar, that is driven by the China story that I mentioned earlier. And this part of the cycle is typically strong for emerging markets versus developed markets, because you're kind of right at the end of it, where where the higher beta works well in that space. So I'd say, think about where you're investing your risk assets into, because that is as important as just being overweight risk, which I mentioned earlier. So in when it comes to corporate bonds, we prefer and are overweight high yield bonds versus investment grade, and that there's quite an important return profile difference that we're seeing from high yield bonds that is helping our performance to tick along nicely. And similarly, just it's not all about upside, but on the downside as well. And this is to admit to perhaps a mistake that we might have made. We probably own more gilts than we should have done. We should have had a better spread amongst US Treasuries and European government bonds, bonds, and we perhaps been a bit more overweight gilts than we should have been. And actually Treasuries have done relatively well, while gilts have been okay, flat year to date, whereas Treasuries are up. So I'd also say, when you're looking at what's defensive in your portfolio going into year end, just think about whether you've got, the correct positioning in government bond markets, because that can also be an important source of downside protection, but also, as I mentioned, in this bullish world, also producing upside as interest rates are cut, globally.
Thank you for speaking with me today, Jordan. This was informative, as it always is.
Thanks, Kimberley. Appreciate you having me on the show.
Thank you for listening to In Conversation With. We do hope that you enjoyed it. Please do keep up to date with all our new releases via Podbean, Apple Podcasts, Spotify, and everywhere else you get your podcasts from. You can also keep up to date with all our new content published on the Money Marketing website, as well as our print edition Money Marketing magazine. So make sure to subscribe. Follow us on Twitter, LinkedIn, Facebook, and Instagram. See you next time.